and welcome to Carborundum Universal Limited Q2 FY25 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you, and over to you, ma'am.
Thank you, and warm welcome to everyone on the 2Q FY25 earnings call of Carborundum Universal Limited. We have the management today being represented by Mr. Sridharan Rangarajan, Managing Director, Mr. Sushil Bendale, Chief Financial Officer, Mr. G. Chandramouli, Advisor Investor Relations, and Mr. Dinesh Kumar, Senior Manager Strategic Planning. At this point, I'll hand over the floor to Mr. Rangarajan for his initial remarks, post which we'll open up the floor for Q&A. Thank you, and over to you, sir.
Good morning. I'm Chandramouli. Let us start the proceeding with the disclaimer class. During this call, we may make certain statements which reflect our outlook for the future or which could be construed as forward-looking statements. These statements are based on management current expectation and are associated with uncertainties and risks are more fully detailed in our annual report, which may cause the actual result to differ. Hence, these statements must be reviewed in conjunction with the risk that the company faces. Thank you.
Thank you. Good morning to all of you, and a warm welcome for our second quarter earnings call for this financial year FY24-25. First of all, a very happy Diwali to all of you. Hope this year brings a lot of wealth, peace, and health to all of you and your family. Today, I'm joined in this call by Sushil Bendale, our CFO, Chandramouli, who handles the investor relationship, and Dinesh, who handles the strategic planning. I'll provide an overview of the company's performance for the quarter as well as the first half, and then we will open up for questions. So first to start with, I'll talk about the performance of Q2 and H1 FY25. Consolidated financial results. Consolidated Q2 was rupees 1,209 crores. This is the highest quarterly sales. This was a growth of 7.6% compared to Q2 FY24. This growth was contributed by all three segments. Electrominerals contributed about 6.5% growth, abrasives about 6.4%, and ceramics 5.5% growth. Compared to Q1 FY25, sales in this quarter grew by 2.1%, electrominerals grew by 5.6%, ceramics grew by 3.7%, and abrasives was lower by 1.5%. Consolidated sales for H1 FY25 was rupees 2,393 crores, with a growth of 3.4% compared to the same period last year. The growth was contributed by growth in abrasives, which was at 6.4%. Electrominerals was lower by 1.6%, while ceramics was lower by 0.5%. Now coming to the profit before interest and tax for Q2 FY25. Q2, the PBIT was 154 crores. This was a growth of 9.2% over Q2 FY24. Compared to Q1 FY25, PBIT grew by 3.4%. So both quarter on quarter as well as sequential, there is a growth. PBIT margin at consolidated level improved from 12.6% in Q1 FY24 to 12.8% in Q2 FY25. PBIT for the first half of the year was 304 crores compared to 296 crores in H1 FY24. PBIT margin percentage for the first half of the year was at 12.7% as against 12.8% in H1 FY24. Profit after tax for Q2 FY25 was 116 crores, showing a growth of 13.7% compared to profit after tax for Q2 FY24. Profit after tax for Q2 FY25 improved by 2.6% when compared to profit after tax of Q1 FY25. Profit after tax for H1 FY25 grew by 6.4% to 229 crores compared to H1 FY24. PAT margin increased from 9.3% to 9.6%. Now I'll cover the standalone performance. Standalone Q2 was rupees 705 crores with a growth of 9.6% compared to Q2 FY24. This growth was contributed again by all three segments. Electrominerals contributed about 9.2% growth, abrasives 8% and ceramics 4.8%. Compared to Q1 FY25, sales in this quarter grew by 6.3%, electrominerals grew by 11.2%, ceramics grew by 5.2%, abrasives grew by 1.7%. Standalone sales for H1 FY25 was 1,369 crores with a growth of 5.1% compared to same period last year. This was contributed by growth in abrasives and electrominerals at 7.6% and 2.4% respectively. There was a marginal drop of 0.8% in ceramic segment. PBIT for Q2 FY25 was rupees 116 crores with a growth of 4.4% over Q2 FY24. This was contributed by 8.6% growth in ceramics and 4% growth in abrasives over Q2 FY24. Electromineral PBIT was lower by 6.2% when compared to Q2 FY24. Compared to Q1 FY25, PBIT in Q2 FY25 degrew by 3.2%. PBIT of electrominerals and ceramics in Q2 FY25 grew by 33.3% and 26% respectively. Abrasives were lower by 7%. There were unallocable expense of 17.6 crores in Q2 FY25 compared to unallocable income of 0.7 crores in Q1 FY25. More details on unallocable part will be covered by Sushil later. PBIT for the first half of the year grew by 0.9% to 235 crores against 233 crores in H1 FY24. PBIT margin percentage to sales at standalone level was decreased from 17.2% in Q2 FY24 to 16.4% in Q2 FY25. The margin in Q1 FY25 was at 18%. There was a small decrease in PBIT margin percentage from 17.9% in H1 FY24 to 17.2% in H1 FY25. Profit after tax for H1 FY25 grew by 2.2% to 180 crores when compared to H1 FY24. PAT margin decreased from 13.5% to 13.1%. On a quarterly basis, PAT grew by 4.4% to 86 crores when compared to Q2 FY24. PAT was lower by 7.3% when compared to Q1 FY25. Now I'll cover the performance of each segment. Now to start with abrasives, consolidated abrasives sales for H1 FY25 was 1,095 crores with a growth of 6.4% when compared to the same period last year. Standalone business, Rhodius and Avuco showed good growth compared to H1 FY24, whereas Sterling Abrasives and Fimi America had a small negative growth. Q2 FY25 sales was at 543 crores with a growth of 6.4% compared to the same period last year. This was growth contributed by standalone, Avuco and Rhodius, including WA. Compared to Q1 FY25, sales was lower by 1.5%. This largely coming out of the lower sales in Avuco. Standalone abrasives, Q2 FY25 standalone abrasives grew by 8% to 308 crores compared to Q2 FY24. Industrial segment, retail segment registered double-digit growth, while precision was marginally lower compared to last year. The growth was mainly on there was also a small negative growth in exports. In comparison to Q1 FY25, there was a marginal growth of 1.7%. Sales for H1 FY25 was 611 crores with a growth of 7.6% compared to the same period last year. The growth was majorly driven by industrial, retail, while there was a small degrowth in precision. The growth in H1 FY25 over H1 FY24 was predominantly volume-driven growth. Now I'll go to Rhodius. Rhodius in H1 FY25 achieved a net sales of 33.8 million euro compared to 30.7 million euro in H1 FY24. This represents a 10% growth in euro terms over the last year. There was an increase in volume, which is the predominant part. For the quarter, Rhodius achieved net sales of 16.5 million, which is 8.5% growth over Q2 FY24. And compared to Q1, there was a lower growth of 4%, reflecting the seasonality of their business. In H1 FY25, Rhodius incurred a loss of 0.1 million euro against the loss of 1.4 million euro in H1 FY24. So this means the losses are coming down significantly. It is to be noted that this is after the PPA write-off of euro 1.4 million. We expect a growth of 9% on a full year basis as against 10% what we communicated earlier in the call. We expect a break-even on a full year basis against the small profit what we told in our previous calls. Please note that this would also mean a significant loss reduction compared to the last year. It is to be noted that these numbers are after the PPA write-off of euro 2.8 billion on full year basis. I'll move to Awuko. Awuko achieved a sales of 5.3 million for the first half of the year. This is a growth of 18% compared to the last year same period. For the quarter, Awuko delivered a sale of 2.2 million, which is 17% growth over the same period last year. Sequentially, it was lower by 26% compared to Q1 FY25. The losses before tax on H1 basis are at similar level as that of H1 FY24 at 2.3 million. Operationally, Awuko improved their performance compared to the last year. We earlier communicated that Awuko would increase their yearly sales by 8 million to 10 million euro. We also said that Awuko would break even at EBITDA level and have a small loss of 0.7 million to 1 million by FY25. Currently, we feel at full year, Awuko would increase their sales around 2 million. We expect an EBITDA loss of around 4.5 million. The reason for not achieving the planned sales are product portfolio change to more converted products and less jumbo rolls. This resulted in capacity constraint, higher lead times and cost. Focus of customer business and target market did not develop as planned. Delays in achieving acceptable levels of quality. We are working on a strategy to improve Awuko's performance. I will share more details in the next 6 months. The current Q3 and Q4 we have fully covered and I have explained. Beyond that, I will cover in the next 6 months when I come and meet you. Now I will cover the performance of profit before interest and tax. Consolidated abrasives PBIT for the first half of the year grew significantly to 90 crores from 68 crores in H1 FY24. Representing a growth of 31%. This resulted in margins improving from 6.6% in H1 FY24 to 8.2% in H1 FY25. This was mainly due to standalone's PBIT growing at 13.3% and Rhodius delivering a small PBIT compared to negative H1 FY24. Consolidated PBIT for Q2 FY25 was 34 crores with a degrowth of 7.1% 1% compared to Q2 FY24. This was due to PBIT degrowth in sterling abrasives, CUMI America, and AWUKO. While compared with Q1 FY25, the PBIT was lower by 21 crores. This was mainly due to lower PBIT in AWUKO by 5 crores, Rhodius by 9 crores, and standalone by 4 crores. AWUKO was due to lower sales, Rhodius was due to lower sales, product mix, and the cost push. I'll move to electrominerals. Consolidated sales in H1 FY25 was 783 crores, which is slightly lower by 1.6% compared to the same period last year. Standalone business and Foskor Zirconia showed growth compared to H1 FY24. VAW Russia in local currency delivered similar performance compared to the last year, but had a small degrowth when converted to INR. Q2 FY25 sales was 402 crores with a growth of 6.5% compared to Q2 FY24. The growth was contributed by standalone, VAW, and Foskor. In comparison to Q1 FY25, sales grew by 5.6%. Standalone business and VAW showed growth. Foskor degrew, the details of which I will cover in Foskor's section. Standalone electrominerals, standalone Q2 was rupees 210 crores. This is the highest quarterly sales. It is a 9.2% growth compared to Q2 FY25. This growth was aided by volume increase and higher price realizations. This growth was also because of the higher export sales. Compared to Q1 FY25, sales in this quarter grew by 11.2%. This growth was aided by volume increase and higher price realization. Sales for H1 FY25 was at rupees 399 crores with a growth of 2.4% compared to the same period last year. This growth was aided by marginal volume increase and a small increase in price realization. The other feature of the growth is higher export and volume growth in value-added products. VAW, the operations are running well and the capacity utilizations are slightly better compared to the last year. Sales in local currency for Q2 FY25 degrew marginally by 1.7% compared to Q2 FY24, which I explained largely, very, very small marginal degrowth, and grew 1% compared to Q1 FY25. They delivered a profit after tax of ruble 466 million in Q2 FY25 against ruble 413 million during the same period last year and ruble 287 million in Q1 FY25. H1 FY25 profits were ruble 753 million compared to 836 million during the same period last year. There was no major impact on exchange rate conversion in INR in comparison to last year. I'll move to Foskor. For the quarter, sales grew by 38% compared to Q2 FY24. This is predominantly coming out of a volume increase. However, compared to Q1 25, there was a drop of 32%. China dropping the price has impacted the volumes. First half of FY25 witnessed a volume growth of 26% compared to H1 FY24. However, the price realization dropped to an extent of 17%, resulting in a net sales growth of 9%. Foskor Zirconia in H1 FY25 incurred a loss of 14.7 crores compared to a loss of 6.1 crores in H1 FY24. The increase in loss is mainly on account of strengthening of the South African rand against the US dollar in this quarter by around 10%. We have now considered the pricing pressure in the market and rolled up H2 FY25 outlook. We feel Foskor Zirconia loss in H2 could be in the range of 2 crores against H1 FY25 loss of 14.7 crores. Overall, the full year loss for FY24 was 7.4 crores, and in FY25 we expect it could be in the range of 16 to 17 crores. Now I'll cover the performance of PBIT of this segment. Consolidated PBIT for Q2 FY25 was at rupees 58 crores. This was a growth of 33% compared to Q1 FY25. Standalone business and VAW contributed to this growth. In comparison to Q2 FY24, it was lower by 6.4%. This was mainly due to standalone and Foskers PBIT. PBIT margin at consolidated level was at 14.3% in Q2 FY25 compared to 11.4% in Q1 FY25 and 16.3% in Q2 FY24. In H1 FY25, PBIT was 101 crores compared to 136 crores in H1 FY24. This resulted in a margin decrease from 17% to 12.9%. Standalone Electrominerals PBIT decreased from 46 to 38 crores. Drop is mainly due to pricing pressure in the market. The increase in PBIT loss in Foskers Zirconia to the extent of rupees 8 crores, which was mainly on account of strengthening of the South African rand against dollar. VAW's PBIT dropped by 18 crores due to the export duty, higher freight costs, etc. That's the broad reason for the swing. I'll move to ceramics section. Consolidated sales for H1 FY25 was 549 crores compared to 552 crores in H1 FY24. Q2 FY25 sales was 280 crores compared to 265 crores in Q2 FY24. The growth was contributed mainly by CUMI India and America. Compared to Q1 FY25, sales grew from 270 crores to 280 crores, that is 3.7%. Standalone business and CUMI Australia showed growth. Standalone ceramics Q2 sales was 228 crores with a growth of 4.8% compared to Q2 FY24. This growth was aided by volume increase and higher price realization. Compared to Q1 FY25, sales in this quarter grew by 5.2%. This growth was mainly contributed by higher price realizations. Sales for H1 FY25 was 444 crores. This is lower by 0.8% compared to the same period last year. Fired and mono-refractories, wire ceramics and metallized cylinder business at standalone combined together grew at 14% compared to H1 FY24. Sales were lower in engineered ceramics and corrosion resistance business. Subsidiary in America on H1 basis registered good growth, whereas Australian subsidiary was marginally better compared to H1 of the last year. Now I'll cover the PBIT of this segment. Consolidated PBIT for Q2 FY25 was 80 crores. This was a growth of 23% compared to Q1 FY25. This was contributed by double-digit PBIT growth in standalone, CUMI Australia and VAW Russia. In comparison to Q2 FY24, there was a growth of 8%. This was mainly due to PBIT growth in standalone and VAW. PBIT margins in Q2 FY25 was at 28.5% compared to 24% in Q1 FY25 and 27.8% in Q2 FY24. Consolidated PBIT for H1 FY25 was 144 crores compared to 154.5 crores in H1 24. This resulted in margin decrease from 28% to 26.3% in H1 FY25. This was mainly due to standalone ceramics. Standalone ceramics PBIT decreased by 6.7% to 111 crores on account of mix between industrial ceramics and refractories and product mix within the industrial ceramics. This covers the performance section. Now I will also make a quick update on recent acquisition that we have made. We completed the acquisition of 100% stake in silicon carbide products, a refractory product manufacturer based in Horsehead, at an enterprise value of $6.66 million. SCP specializes in manufacture of high-quality nitride bonded silicon carbide products and are widely recognized for their advanced firing and forming process. This acquisition aligns with our strategic expansion plan and offers synergies in the market access, technology capabilities, and raw material supply opportunities. Using SCP's expertise in furnace design, patterning, and tooling, CUMI aims to strengthen our offering in the Indian market, particularly in the critical thermal application such as power, steel, mining sectors. Additionally, we anticipate leveraging SCP's well-established customer base in Americas to introduce CUMI's product into industries such as glass, superalloys, petrochemicals, non-ferrous, and heat treatment. We expect to see further synergies, including potential to supply CUMI's grade of raw materials to SCP and to jointly develop new products and technology. Additionally, this acquisition will almost double our NBSIC production capacity. SCP closed last year, that is calendar year 2023, with 4.2 million in revenue and 0.4 million in profit before tax, with a projection to double the revenue over the next 5 to 6 years based on the current estimated growth trajectory. We believe that the identified synergies could generate an additional $5 million in annual revenue by the end of this period. We are in the process of crystallizing specific synergy programs and will provide a more comprehensive update of our integration and synergies in the next 6 months. Now I would request Sushil to cover the PBIT margin, debt positions, capex, cash flows, and ROC. Thank you.
So first I'll speak about the PBIT margin. On an H1 basis, consolidated PBIT margin was at 12.7% compared to 12.8% in H1 24. This was majorly contributed by better performance in abrasive segment. For the quarter, consolidated PBIT margin was at 12.8% compared to 12.6% in Q2 24 as well as in Q1 25. Now standalone PBIT margin for H1 25 was at 17.2% compared to 17.9% in H1 24. For the quarter, standalone PBIT margin was at 16.4% compared to 17.2% in Q2 24 and 18% in Q1 25. Now I'll share the segment specifics. Abrasives. Consolidated PBIT margins of abrasives on H1 basis improved from 6.6% to 8.2%, mainly because of standalone abrasives margins improving from 16% to 16.9% and Rhodius delivering small profit in H1 25. For the quarter, consolidated abrasives margin declined from 7.3% in Q2 24 to 6.3% in Q2 25. The margins dropped by 364 basis points compared to Q1 25, which was contributed by a decline in standalone margins from 17.6% to 16.1%, increased losses in Awuko, and margins moving from positive to negative for Rhodius. Now, electrominerals. Consolidated PBIT margins of electrominerals on an H1 basis declined from 17% to 12.9%. The standalone PBIT margin of H1 25 was at 9.4% compared to 11.7% in H1 24. This drop is mainly due to pricing pressures in the market. Also, losses increased in Foskor on an H1 basis, primarily on account of strengthening of the South African rand against USD. For the quarter, consolidated electrominerals margins declined from 16.3% in Q2 24 to 14.3% in Q2 25. Standalone electrominerals PBIT margins decreased from 11.9% in Q2 24 to 10.3% in Q2 25. The drop is mainly due to pricing pressures in the market. The consolidated electrominerals margins improved by 296 basis points compared to Q1 of 25, which was contributed primarily by improvement in margins of standalone and VAW. The standalone margins in Q2 25 improved by 170 basis points compared to Q1 25, mainly on account of better price realization. Ceramics. Consolidated ceramics margins improved from 27.8% in Q2 24 to 28.5% in Q2 25. Standalone ceramics PBIT margins improved from 26.2% in Q2 24 to 27.2% in Q2 25. In comparison to Q1 25, the PBIT margins improved by 449 basis points, which was contributed by improvement in margins of standalone and CUMI Australia. The standalone margins improved from 22.7% to 27.2% on account of higher price realization and favorable product mix. The consolidated PBIT margins of ceramics on H1 basis declined from 28% to 26.3%, primarily due to standalone performance. Standalone margins decreased from 26.6% to 25% due to mix between industrial ceramics and refractories and product mix within industrial ceramics. Now I'll speak about the debt position. There was no debt in our standalone books, and total debt at the consolidated basis was at 103 crores at the end of Q2 25 compared to 140 crores at the end of Q2 24 and 112 crores at the end of Q1 25. The debt to equity ratio was at 0.03 at a consolidated level. CapEx during H1 of 25, our CapEx investment was rupees 124 crores at the consolidated level. Return on capital employed for H1 25, the return on capital employed at a consolidated level is 17% compared to 19% during the same period last year, and at a standalone level it is at 19.3% compared to 21.5%. For the consolidated business, the ROCE in H1 25 for abrasives improved from 10.2% to 12.3%, while ceramics has declined from 51.7% to 44%, and electrominerals has decreased from 31.7% to 19.4%. For the standalone businesses, ROCE for H1 25 for abrasives has marginally decreased from 41.3% to 41%, while ceramics has declined from 54.9% to 46.8%, and electrominerals has decreased from 31.3% to 21.5%. Now I'll speak about the unallocable expenses. At a standalone level, the unallocable expenses in Q2 25 were at 17.6 crores, which is similar to the unallocable expense in Q2 24. In Q1 25, the unallocable income was 0.7 crores. This is primarily due to dividend receipts in Q1 25. On an H1 25 basis, unallocable expenses were 16.9 crores, lower by rupees 6.1 crores compared to the same period last year, primarily due to higher interest income in H1 of 25. At a consolidated level, unallocable expenses for Q2 25 were 11.2 crores compared to Q2 24. Unallocable expenses were lower by 14.7 crores, primarily due to higher interest income in Q2 25, exchange loss in receipt of dividends from VAW in Q2 25, higher project-related costs in Q2 24, and lower spend in Q2 25. Compared to Q1 25, the unallocable expenses were almost flat. On the half-year basis, unallocable expenses at the consolidated level were rupees 23.4 crores, lower by rupees 28.2 crores compared to H1 24, primarily due to higher interest income in H1 25, exchange loss in receipt of dividend from VAW booked in H1 24, which is not there in H1 25, higher project-related costs in H1 24, and lower expenses in H1 25. Now I request Mr. Sridharan to take you through the next section related to the future outlook. Thank you.
Thank you, Sushil. So I'll just make a quick overview what we said last time versus where do we stand after looking at the first half. We communicated that our full year consolidated sales could be 9% to 11%. On the consolidated sales could be 5,100 to 5,200 crores. We maintain the same. In consolidated abrasives, we expect a growth of 10% as against 11% to 12% what we communicated earlier. This shortfall is mainly coming from AWUKO. We communicated during our last call a growth of 8 million to 10 million euro from AWUKO. Currently, we feel that full year AWUKO could rise their sales around 2 million euro. Abrasives India growth would be 9% to 11%, which is as communicated to you earlier. Rhodius is doing well in H1 FY25. Rhodius delivered a growth of 11.6% in Indian rupees. We communicated earlier a growth of 10% on full year basis can be expected. We feel it could be 9% to 10%. We communicated about sales growth of 12% to 14% in consolidated ceramic segment. We maintain the same. For industrial ceramics business in India, we communicated about a growth projection of 13 to 15%. We expect some shortfall in engineered and vast ceramic segment. This would lead to around 12% year-on-year year growth, 1% lower than what we communicated. CUMI Australia and CUMI America are doing fine. Refractory, we are confident of delivering 12% to 13% growth over last year on the back of a strong order books, which is also similar to what we communicated. We communicated about sales growth of 5% to 6% in consolidated electromineral segment. We maintained the same. WA is expected to deliver a similar performance to last year. This is what we have planned and what we communicated to you. Growth from standalone business expected to be about 10% growth, as said in the previous call. For Foskor, H1 FY25 did not go as per our plan. They were impacted due to pricing pressure in the market and strengthening of the South African rand against dollar. We expect H2 25 to be better than H1 FY25. On the PBIT performance, we communicated that consolidated PBIT margins would be in the range of 13.7 to 13.8%. We expect it to drop by 100 basis points. This is mainly coming from underperformance by AWUKO in abrasives and Foskor Zirconia in electrominerals. We said that consolidated abrasives margins will improve by 100 basis points in FY25. We expect margins to be similar to that of FY24. Ceramic margin will be similar to that of FY24. We maintain the same. We said that consolidated electrominerals margin will improve by 20 to 30 basis points in FY25. We expect margins to decrease by 150 to 200 basis points from FY24. This is mainly coming from standalone, which is facing cost push and price realization pressure, and Foskor Zirconia, which is facing pricing pressure. On CapEx side, we said that we would spend around 350 crores on a full year basis. So far, we have spent 124 crores. We feel that we would be spending about 300 crores in FY25. To sum up, on the whole, we expect the top line to be 5,100 to 5,200 crores. We expect PAT to be about around 500 crores. We would be spending around 300 crores of capex. We will be debt free. While delivering the current business, we would have prepared a strategic plan for the future of CUMI. We will share about this more in future. With this, I will end my opening remark and thank you all for hearing this out. We will now open up for your question and answers. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Avendus Spark. Please go ahead.
Sir, thanks for taking my question. My first question is with respect to the ceramics and refractory segment. You had talked about reasonable good growth coming in for the engineered ceramics and wear ceramics, etc. If you could give more granular details as to which are the sectors which are driving the growth for these subsegments as of now. There was one large customer from whom business was impacted. How is the path to recovery over there? If you can talk about these two segments and also refractories, what is driving growth there? How is the demand from certain sectors like glass, carbon black, steel, etc.? If you can talk about that would be great.
Thank you for your question. So to start with, I would say the customer that we had impact of slower growth is picking up, and it is the trajectory of what we communicated is very much on track. So that is in control, and as we communicated, we said that calendar year 25, which is what they would focus on, the pickup will be much more, but right now their trajectory is very much on track. We are traveling as per earlier communicated, no issues. As far as the growth in ceramics and refractories, all the normal sectors that we are addressing have witnessed a growth, and we are seeing robust demand for each of them, whether it is cement, steel, carbon black, chemical industries, power distribution. All these sectors we are seeing good demand, both in India as well as overseas, which is what is driving the performance of them. So to sum it up, I think the demand drivers are largely coming from various industries that we serve.
And the metallized cylinder segment, should we kind of think of it as growing like a 15% CAGR kind of segment? I mean, mid-teen kind of growth sustainable over the next 2-3 years?
So I think we gated the ceramic business growth, as I summed up, around 12 to 15% growth. I would expect a similar type of a growth continue because see, it's a mix of various product subsegments which are there, whether it is van, metallized, engineered, fire refractories, mono, prototype business, all put together is a basket of this. So I would assume that kind of a trajectory of growth should be expected.
Understood. And my last question is with respect to the competition in abrasives and electrominerals that you had talked about in the past 2-3 quarters, especially Chinese competition and in abrasives competition from paint companies, etc. How do you see that panning out? Is it same level? Has it intensified or has it come off?
So as far as the competition is focused on electromineral first, is that I think as far as phosphorus zirconia is concerned, the competition from Chinese is severe and their pricing pressure is very much on. So that is what is pulling their sales also down, as well as the impact on their margins. As far as India is concerned, I think we see that so far we are able to pass on the cost increase that we are getting to the market, and we will have to wait and see how the second half would span from the Chinese competition. We expect, they would also face a similar cost pressure because it's a global pressure that everyone is facing. So obviously there would be their reactions to that also. But nevertheless, it is difficult to gauge how the Chinese would react. But we are working cautiously in terms of explaining things to our customer. They understand where the cost drivers are coming from, and they are in a position to pass on the cost increase that we are getting. And so as far as the abrasives, paint, is a very small sector, as I was also alluding to, is a very specialized small sector that they were focusing on compared to the whole range of abrasive products. I think that is continuing, and probably with kind of many pressures that paint industry is going through, the focus is on their core industry than, I would say, focusing on the abrasives at this point in time.
Understood, sir. Yeah, thanks a lot.
Thank you.
Thank you. The next question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Thank you very much for the opportunity, sir. So my first question is on our abrasive subsidiaries. Why was the performance at CUNY America weak in the second quarter of FY25? If I remember correctly, the performance was weak in first quarter of FY25 as well, as the sales had declined both YOY as well as QOQ. And similarly for the sterling abrasives as well, now the performance has been weak for the 2 consecutive quarters. Anything specific you would like to highlight on both these?
So I think, could you repeat the second question on sterling?
Sure. Yes. Similarly, the sterling abrasives performance has also been pretty weak for the 2 consecutive quarters. On one hand, the agro processing market is doing fairly well, going by the commentary of other peers operating in the same segment. So anything specific you would like to highlight on both sales as well as margins here?
Right. No, that's a good commentary from you, Harshit. I think as far as Sterling is concerned, I think they were impacted largely from one particular product segment called cone polishers, which removes the husk from the rice and paddy. That is what is their business. And because of a government policy change, which expects certain percentage of rice to be returned post dehusking process, that cannot be maintained, which is probably very high, and cannot be maintained by any millers at this point in time. So the millers have stopped pretty much, at least on the two states, which is Punjab and Haryana. This has stopped, and that is the result of slowdown, and which is what has caused Sterling Abrasives business slowdown, which I think probably will get corrected post policy changes, etc. would happen. As far as CUMI America is concerned, I think, they had a very good business. Even at this point in time, they are doing well. Largely, the dependence on one customer, which is, have shifted their facility from US to Latin America, and that shift has cost, it would take a year for them to stabilize, because they had quite a lot of inventory at this point in time, which is going to be currently consumed. If I remove that customer and start looking at their growth, is really good. So there will be a blip, which I think we very well understand. It will get back. We have invested in people in USA. 3 new headcounts were added. It's a focused market. I think it will come back very nicely. We are confident of getting it back.
Understood. Sure. So my second question is on Awuko and Rhodius. So what is the end user industry mix for both these companies? As in, what percentage of sales are derived from automobile, construction, general engineering, retail, etc. over there?
So as far as Awuko is concerned, it is leather and wood are the two major industry segments that they serve. There is also a few other small segments, but this is the two one. As far as Rhodius is concerned, it serves wide range of industries. Industries including construction, infrastructure related to this. This is largely, a thin wheel, and thin wheel has got a wider application in very many industries. These are the industries they serve.
The focus or the concentration on automobile industry is not very high over there?
No, not very high.
Understood. So just a small question, if I can squeeze it. You have decreased your capex guidance by close to 50 crore from 350 crore earlier to 300 crore. So is this just a postponement of the capex, or some capex structurally we are not going to do at all? So if you can give some
timing difference. No postponement. All capex will be this one. It is because of some starting delays, some timing differences. I am just giving that guidance. Otherwise, it will be very much on whatever we plan. We will spend on each of these critical capex.
Understood. Thank you very much, sir, for answering my questions, and all the best.
Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is on the line of Bhumika Nair from DAM Capital Advisors. Please go ahead.
Yeah. So just couple of clarifications, why on, let me start with electrominerals. Now, while, Foskor has seen a weaker than anticipated performance, but if I look at it on a standalone basis, last 2-3 quarters was weak, and we started seeing some improvement in the current quarter. And if I remember earlier, you had mentioned that there was some dumping by the Chinese guys both out here, and HIC prices had also fallen, which was impacting WAR. So if you can just comment on that, while the pain seems to sustain in Foskor, how is, there seems to be some improvement on standalone as also in WAS. If you can just throw some light on that aspect.
So I think as far as India domestic pricing pressure and competition from China is concerned, no change. It is the same. If you look at it, I think our pickup in margin is largely volume plus also a mix which helped us to pick up this margin, which is 8.5% moving to 10.3%. We expect, the cost pressure, which is largely coming out of the alumina's prices going up, is impacting most of the electromineral products, which are white and brown fused, has going through at this point in time. And to that extent, I would say we will see this pricing pressure. We are trying our best to pass on in the market, but China competition is a bit unpredictable. The logics of why would they price differently, God alone knows at this point in time, because when you have a global alumina cost increase, which is very well known, everyone can read and comment about that, but at this point in time, this is what we are seeing. As far as the SIC competition from China is very mild, I wouldn't put it the way that what we are seeing here in India.
Okay. Sir, also in terms of, within EMD, we were looking at, high performance materials, and we are setting up the HPSIC plant. If you can just comment on that, where are we in terms of the construction? When does the plant get commissioned? How can we see scale up of that plant over the next few years, while it will get operational soon, but more from a scale up perspective, because it's a smaller project right now. What is the feedback that you're getting from the market? How quickly can we scale it up? Will it be a long-term process to scale it up, or can we kind of scale it up much faster? So some thoughts on that, sir.
So first of all, the project is very much on track as far as the HPSIC is concerned. And we expect, the first off of, we talked about December 25, is where we said we will have the full utilization will start happening as far as this project is concerned. We expect could be much earlier than that, but I think let's still maintain the same guideline as what we told. We expect, as you rightly observed, this is a small project. We expect establishing the products to start with. This is what we are currently trying to do. We have seeded this. We have sent some of the products to few geographies where we are getting reasonably good feedback, and we will wait to share with you more as we go progress on that. So far, so good. I think it looks interesting at this point in time.
Okay. And what about, the other areas like, say, graphene or graphite or anything else to materially talk about any progress, or, or maybe, if you can talk about how large can this whole specialty piece become over the next 2-3 years? Any thoughts on that?
Yeah. No, I think that's what I meant in my closing remark. We would be sharing some of these details in the next 6 months as we are working on the long-term strategy on each of these areas that you talked about, plus a few more areas that we have listed as well. We will share that. At this point in time, I am not in a position to share this.
Sure. Sir, on ceramics, how should we look at in terms of the margin profile? And, year two, we are working on a lot of technical ceramic aspect of the entire business. So how is that share kind of scaling up? If you can, throw some light on in terms of what was technical ceramics as a percentage of the segment revenues and what it is today and what it can possibly get to, so that we understand, how the margins might scale up. And if you can also talk about, the net cylinder capacity, where are we in terms of utilization, any plans to further expand capacity up there?
Right. So I think as far as the programs in ceramic side is concerned, all of them have hit the ground. We have construction is on the full swing, whether it is a ceramic for semiconductors, ceramic for defense is very much on, and we are progressing as per the schedule. We have also looked at few other areas within ceramics. We expect ceramics margins could go up based on these type of newer opportunities, but I am not in a position to share what kind of a growth, etc. But I would say the current profile of margins that we are seeing should continue, should improve as we start bringing these newer ones, which is what I said, that step one for this year is delivering the 5,100 crores to 5,200 crores is what our current trajectory. And in 6 months' time, maybe we will share a brief profile of what are all the initiatives that we are looking at in each of these segments, what we plan to do. So that we will be able to share and maybe to give some more color to these type of growth and margins, etc., and where these growths will come from. As far as the metallized cylinder capacity is concerned, I think we are very well operating capacities. We should be in the range of about 80% plus capacity utilization, and I feel that we may be in a position to increase depending on few debottleneckings, etc. I think we are very much on track.